In simple business terms, financial statements are used to outline its financial activities by providing a collection of data about a company's financial performance, its current conditions, and its cash flows. Accountants must adhere to generally accepted accounting principles to maintain a consistency of information and presentation across international borders. There are 4 financial reporting segments that must be adhered to. First, we have the statement of financial position, also recognised as the balance sheet. You, as an investor or creditor, may be wondering what the business owns and what does it owe. A statement of financial position provides answers to these questions by reporting a business's assets, liabilities, and equity. An asset is a business's resource that will provide future economic benefit. Examples include inventories, receivables, property, plant, and equipment. On the other hand, a liability is an obligation of a business which will require the sacrifice of economic resources at some future date. Examples of liabilities include accounts payable to suppliers, salaries payable to employees, and taxes payable to the government. Equity represents the share of assets that are claimed by the business owners, also interpreted as the difference between the cost of the business's assets and its liabilities. Equity can be generated in 2 ways. The first is through contributed capital, defined as the resources that investors contribute to a business in exchange for an ownership interest. The second way falls under profitable operations. The profits formed can either be redistributed as dividends to owners or as retained earnings, which are profits kept in the business. The statement of changes in equity allows owners of a particular business to know that equity is distributed in the form of dividends, also showing changes in retained earnings over a specific period of time. The basic structure of the statement starts off with calculating a business's beginning balance of retained earnings and then adding or deducting, depending on whether it is a net profit or loss. By subtracting the dividends distributed to owners, the ending balance of retained earnings for that particular period is calculated. Is the period profitable? Does it generate more resources than it uses? Are some of the main questions asked of any business. Through the reporting of a company's revenues and expenses, the Statement of Comprehensive Income provides answers to these critical questions. Revenue results from an increase in resources due to the sale of goods or the provision of services. On the other hand, expenses are a decrease in resources due to the sale of goods or provision of services. Examples include wages, taxes, advertising, and utilities. Its purpose is to demonstrate the financial success or failure of a business over a specific period of time. It is formalized through subtracting total expenses from total revenues to calculate the net profit or net loss. Where does a company get its cash? Where does its cash go? Are questions often sought out by various stakeholders. A cash flow statement reports a business's cash inflows and outflows from multiple activities which include operating, investing, and financing. Under financing activities arises the need for businesses to raise funds to begin. There are 2 main ways for funds to be raised. These include borrowing money from creditors and receiving contributions from investors. After sufficient funds have been raised, investing activities partake. These activities usually require the revenue-generating assets that it needs for operations, which in turn leads to operating activities as the proper equipment has been acquired. Operating activities include purchasing supplies, the payment of employees, and the sale of products.
Created using Powtoon.